Hello everyone and welcome back to another Stock Unlock video. In today's video, we're going to be taking a look at 4 different stocks using our Stock Unlock insights because I want to show you all just how easy it is to find fundamentally sound businesses by using our insights that we have here in our platform. So with that being said, let's hop into the first stock right now. And this one is INMD or InMode. Now, very quickly, first off, what our insights are is they essentially take all of the key fundamental data that investors take a look at when they are analyzing a business and its fundamentals. We then grade and score all of these different key fundamentals and report that back to you, the user. So you can quickly and easily analyze the company's fundamentals yourself, and you don't have to dig through all of the numbers on your own. With that being said, take a look at this. Right here, we can see that INMD's profitability has a score of 5.0 out of 5. It's a perfect 5.0, which means that this business is highly profitable. We can see that the gross margin is 84%, operating margin 45%, net margin 43%, free cash flow margin basically 45%, and the cash conversion is over 100%. So basically all of InMode's margins are very good, which is exactly what Stock Unlock here reports. The next segment here is our valuation segment, and you will notice that we don't score the valuation segment because here on Stock Unlock, we don't really want to incentivize you or push you to thinking that a stock is cheap or expensive. We really want you to come to your own conclusions and think objectively for yourself. With that being said, we can see that InMode's price to earnings ratio right now is below its 4-year average. So is the price to free cash flow and the price to sales. So relative to how InMode has been valued historically, the stock is selling below those price ratios right now. Next, we're going to take a look at InMode's growth segment, and we can see that it once again has a perfect 5.0. Its revenue is increasing very, very fast. Net income is increasing, free cash flow is increasing, book value is increasing, and tangible book value is increasing at rates that are much faster than the overall S&P 500 average. So this business is growing a lot faster than essentially your average company in the market. If we move on to the financial health, this segment shows us a lot about the company's financial health. It tells us and gives us insights into the balance sheet. And right here, we can see that the company's current ratio is near 9. It is debt-free, so this company doesn't have any debt. Unfortunately, it looks like the shares have increased over the past year, but the company has way more cash than total liabilities. So its cash position right now could be used to wipe out all of its liabilities, and again, the company is debt-free. If we take a look at the analyst segment, it has a 4.4 out of 5, which essentially just means that analysts are quite bullish on the company. We can see that down here, the average analyst price target is 39% above where the stock is currently trading. So analysts right now think that this stock is undervalued. Now, lastly, we have our return segment, which is another perfect 5.0 out of 5. The ROIC, ROCE, return on equity, and return on assets are all very high and very good. And what these numbers right here tell you as the investor is how effective the company is and how effective the management is at investing the company's money and producing returns for shareholders. So when I take a look at these Stock Unlock insights for InMode, INMD, I see very strong insights and very strong fundamentals. This company is very profitable. Its valuation is currently lower than its averages. It's got really strong growth. It's got a very strong balance sheet. The management is very effective at investing the capital into growth, and analysts also seem very optimistic on the company's future. This is one of the best Stock Unlock insights that I have ever seen for a company, to be honest, and that's why I wanted to feature it first in this video. Now let's move on to the next stock that has strong fundamentals. Not quite as strong as InMode apparently, but still has strong fundamentals. This one is Microsoft. This is a stock that I think a lot of people know about. It's one of the largest companies in the world. So right away, let's start off with the valuation. And right now we can see that the price to earnings, price to free cash flow, and price to sales are all just average. And the price to free cash flow and price to sales are actually above Microsoft's 5-year average, which can tell you as the investor that maybe this stock is selling a little bit above fair value right now, or at least the market is pricing it above where it has historically traded. We can also see, however, that Microsoft has far outpaced the S&P 500 over the past 5 and 3 years, and the CEO of this business is producing fantastic returns for shareholders. Now, if we move on to dividends, we can see that the dividend yield right now is below the 5-year average as well. So if you are an income investor and you're looking at the dividend yield and you want to buy, Microsoft when the dividend yield is selling at its historical averages, then right now it could tell you that, the dividend yield isn't that high, at least relative to Microsoft's history. And this could be because the market is bidding Microsoft up and potentially selling Microsoft for, higher prices. However, we can see that the dividend per share is increasing at really strong rates. It's also increased consistently over the past 5 years. The payout ratios are also low, and the payout ratios are decreasing. So in terms of the dividend's financial health, it looks incredibly solid. If we head down to Microsoft's growth, it has a 3.8 out of 5, which is pretty good. The revenue is increasing, net income, free cash flow, book value, and tangible book value are all increasing at pretty strong rates. Not quite as strong as InMode, but still pretty darn good, especially for a mega cap company. Now, if we move on to Microsoft's profitability, it's a 4.8. Gross margin is 68.4, which is the only margin here that is not very good, but operating net free cash flow and cash conversion are all very good. So Microsoft is a very profitable business, just like InMode. And I think that that's just a very good thing to see as an investor. Microsoft's returns, 4.8 out of 5. ROIC, ROCE, return on equity, and return on assets are all very good, which basically means that the management is effective at deploying money and investing money, just like we saw with InMode. Financial health is a 3.6. Again, not quite as sound as InMode. Current ratio is 1.78, so it is above 1, but it's not above 2, so it's just kind of average. This is pretty much the average in the market, is to have a current ratio between 1 and 2. We can also see that Microsoft has quite a few intangibles as a percent of its total assets, but it's kind of average in line with a lot of other businesses, around 20%. Microsoft is buying back shares, so we can see that the shares are decreasing. They're returning cash to shareholders that way. That's good. Debt to EBITDA ratio is also very low, which means that Microsoft does not have a lot of debt relative to the EBITDA that the company produces. Good. Cash is also more than current liabilities, which is good. So Microsoft is in a pretty strong financial position. Nothing really to worry about here, if I got to be honest with you guys. Analyst score is 4.0. Analysts think that Microsoft is about 20% undervalued right now, and they think that Microsoft is going to continue growing over the next year. When we take a look at Microsoft, I see a business where analysts are quite bullish on it. It's got a decently strong balance sheet. It's what we're going to do is we're going to take a look at some stocks that do not have strong fundamentals, because you can use Stock Unlock insights to find businesses that, don't have strong fundamentals. They could be losing money, or there could just be a lot of red flags. And we report the good and the bad, you guys. So check this out. This is Beyond Meat, BYND. This company makes essentially fake processed meat. And we can see that the profitability score is 1.4 out of 5, which is pretty dang bad, you guys. Gross margin is bad at only 6.7%. Operating margin, net margin, free cash flow margin are all negative, which means that this business is losing money. You can also see that it's unprofitable, free cash flow negative, and even operating cash flow negative. And it lost about $543 million in the past year in cash outflows. So this business is not profitable, and it is losing hundreds of millions of dollars a year. And you can quickly and easily see that here on our insights. Now, if we head over to growth, another 1.4 out of 5. We can see that the revenue grew by 2% year over year, which honestly is not strong revenue growth. It's just really not that great. Net income decreased, free cash flow decreased, and book value all decreased by over 100% each over the past year. This is not very good to see at all. Honestly, it's very bad. Stock Unlock is right here. This is very bad. Now, however, if we take a look at the financial health, we got a 3.0 out of 5 here. This is because Beyond Meat's current ratio is 7.48, so it does look like the company has a lot of cash relative to its liabilities. And we can actually see here that the cash is more than the company's current liabilities. Oops. So in terms of cash, it has a lot of cash right now. But when you see this, it has decent financial health here. You still have to factor in that, this business is losing $500 million a year. So even though, yeah, it has a lot of cash right now, you have to think about, well, how fast is that cash burning? And in Beyond Meat's case, it's burning at $500 million a year. So then you got to figure out, well, how long does the cash, or how much longer does the company have in cash? You know what? That's an insight that we should probably add, is the cash runway that unprofitable businesses have. I just thought about that, and I'm going to get to the engineers because I think that this could be an important metric in the financial health. But anyways, if we take a look at returns, 1.3 out of 5, also very bad. ROIC is negative 47%. And what that tells you as the investor is that this business is not investing its cash efficiently to produce returns for shareholders. Essentially, it's investing money into growth and it's not seeing any growth. It's actually losing money on those investments at negative 47% or negative 48%. That's very bad, you guys. Very, very bad. ROCE, same thing, negative 27%. Return on equity, 0%. Return on assets. negative 27%. So in all areas, this company is losing money. So when I take a look at Beyond Meat, I see a company that is not profitable. It's losing $543 million a year. Revenue is hardly growing. All of its profitability metrics are decreasing. It looks like the company has a lot of cash on its balance sheet right now, but with the cash outflows and unprofitability, I would expect the financial health to decrease over time, and the management is not investing the company's money effectively. So yeah, maybe not a company that, would be nice to invest in. Now, lastly, we're going to go and take a look at another stock, which is Skillz. Right here, we can see growth 1.8 out of 5. You guys can see that the revenue is decreasing and the profitability metrics and book value are also decreasing. Profitability is 1.9. The gross margin on this business is actually very good, but the operating net free cash flow margin are all incredibly bad. It's unprofitable, and it lost $262 million of cash last year. So just like Beyond Meat, this company is losing money. Financial health is 3.8. It looks like this company has more cash than total liabilities. So this is another company where it has a lot of cash on the balance sheet. But again, you got to think about, well, it's losing money. So how much cash does it actually have left? And then lastly, returns are 1.0 out of 5. That's literally as bad as it can get, you guys, okay? ROIC, ROCE, return on equity, and return on assets, all very, very, very negative. So you can clearly see right here, just by taking a look at our insights within like 30 seconds, you can basically come to your own conclusions if there are red flags, if everything's looking good, and if this may be a business that you want to invest in yourself. Stock Unlock Insights is very powerful. And also, if you don't know what any of these insights mean, like if you don't know what ROIC is, for example, you can click on ROIC and we will explain it right here for you and why we are grading it that way. I just want to show you guys this video really quickly, show you guys how you can use Stock Unlock Insights to find fundamentally sound businesses like InMode and Microsoft, and how you can also use them to avoid some pretty bad investments like Beyond Meat and Skillz. Let me know what you guys think of this video down in the comment section below. Also, if you would like a 7-day free trial to Stock Unlock, and you can come and check out all of your stocks insights. You can get a 7-day free trial. You'll have full access to the platform, and you can come and check out literally every single stock in your portfolio, all of its insights, and see what Stock Unlock has to say about them. All for free. No commitments, no credit card, no nothing. You guys can just come do that for free and play around. So yeah, there will be a link at the top of the description. I hope you guys enjoyed the video. Please leave a like if you did. And that's going to be all from today. Thank you guys again so much for watching, and make sure you subscribe if you want to see more stock market related content like this. And I hope to see you guys all again in our next video. Have a great day.